we're returning to the tax laws we see in 2017, in a matter of 18 months. So we really have 2024 and 2025 to look at some opportunities, to pay lower income tax on dollars clients have saved for 20 or 30 or even 40 years at, at current tax brackets. This is where tax planning and looking ahead really can have a huge impact for people, in the success of meeting their future retirement goal.
Welcome, everybody. We appreciate everybody joining us here today for our webinar on Master the Secrets of Your Tax Return. We look forward to sharing some really good information with all of you here today to help you better understand your overall tax return. But before we get into today's presentation, I would like to introduce you to one of our presenters, Henry Guzzo.
Thanks, Missy. Welcome, everybody. Yes, as Missy said, my name is Henry Guzzo. I've been a financial advisor for over 25 years, along with Missy. And together, we've developed a specialization in tax planning, specifically ideas and strategies to help our clients really view their current tax return, and find ways of expediting, the pace at which, they achieve their financial goals. For many, it's retirement. For others, it's avoiding taxes today, sending kids to school, and other financial objectives. So today, Missy, if you want to advance the slide there, we're going to share some of those ideas with you, to help our clients better understand really the impact of the tax return, what that really looks like, and some ideas to help you with that. And we'll conclude today, with some instructions of how to reach out to us, and some other helpful links, tips that we use, articles on our website. So, Missy, to start, do you believe most people that you talk to believe we have a progressive, or a flat tax system as it relates to the tax return?
Yeah, that's a great question. And I tend to get it a lot, even having meetings with clients is I think overall, I think people believe, we have a progressive system, but ideally in how they think is that we're in a flat tax system. And what I mean by that is, if they have a dollar amount that ends up in, say, the 22% tax bracket, they ultimately feel that all of their income then is being taxed at 22%.
So in summary, people understand we have tax brackets, but the application of that is where oftentimes mistakes or confusion happens.
Exactly.
Yeah, so today we'll spend some time walking through what are those tax brackets. We'll help you with, just some understanding, some basics around what does taxable income mean, what is adjusted gross income, really the construction of the tax return. And we should make note here that we're talking today about the federal tax return. Obviously, some states have flat taxes, some states have progressive taxes, some states, if you're lucky, have no income tax. So we'll walk through some specifics regarding the federal tax return. It should be noted here as we look at the next slide. Our tax brackets range from 10 to 37%. That's the high and the low.
Right. So in this example, we're talking about 2023 because we all have just finished up our 23 tax season. And in this instance, we're talking about a married filing jointly couple. So Henry, in this case, if I said to you, we've got a client that has taxable income of 150,000, what does that mean? What does that mean to you and to the folks that are out here?
Yeah. So again, I think most folks understand we have tax brackets. So in this case, at 150,000 of taxable income, again, we'll get into the depths a little bit more here in the next slide. But in that case, they fall in the 22% tax bracket. Now, what many still don't quite grasp from time to time is what does that mean? Well, what that means is the first 22,000 of that 150,000 is taxed at 10%. Then from 22 to 89 is taxed at 12. And then only the amount above 22,000, or excuse me, above 89,000 is taxed at 22%. What most folks interpret that to be is that, oh, I make 150,000, that's my taxable income. Now I'm paying 22% on all of that income. Would you agree? Is that often the question that you get?
Yes, definitely. And in fact, I just had a conversation with a client a couple of weeks ago, and they were under that same impression that because the excess amount ended up in another tax bracket, they were, that all of their income was taxed at that level.
Well, and it comes in various forms, right, Missy? Like people get a bonus, or
Hmm.
I got an inheritance. Well, the question becomes, oh, because of that, I've moved tax brackets. That's a bad thing, right?
Right.
Well, it depends on your perspective. Maybe it's a bad thing for those last few dollars, but not all of your income is going to end up being taxed at that highest marginal rate.
Correct.
Well, we move to how the tax return is built.
Yeah. All right. So again, we're going to special or take a look at our 2023 1040. So the first section we're going to cover is, a pretty important section. So Henry, why don't you take us through this?
Yeah, so hopefully this looks familiar to everybody. Yeah, this is what your 1040 looks like. This first section that Missy has highlighted for us here is the top section of your tax return. This is where your obviously your name and social security number go. Your filing status in that middle section there, whether it's single, married filing jointly, head of household, and then your dependents below that. So, with data that was released by the IRS in the last 5 years, a high percentage of errors on the tax return actually occur in this area. So, watch for typos. Make sure your address is correct because that'll need to be filed, or you may need to reference that if you're asking for information about your tax return in the future. So, first section is your personal information for you and your dependents.
All right. The next section, this is where all the numbers flow through um, that tie into your income. So we've got items like W-2 wages. We've got taxable interest. We've got qualified and ordinary dividends and capital gains. Those are all generated, from investment statements. And we're going to spend more time on this section in just a little bit. But we also, in this case, we've got IRA distributions. And then we show here, we've got our total income when we add up all those at 180. And then we take what's, in this case, a standard deduction, which drives down our income to what's called taxable income. And that's the amount that is actually taxed.
Yep. So after we've entered our income and found out what the taxable income, page three, or this next section, I should say page two, section three in this case, this is where everything's calculated. So this is where your total tax lies. At the top, you can see the withholdings or payments that you've made. Those then net out that middle section. The only line people really understand about their tax return is, do I owe or am I getting a refund, is here on this page. And this is also where you sign your return, you and the preparer, whether by ink or electronically in most cases in today's world. That's what's on this section. It should be noted here. Make sure to check your routing and account number if that's on file. If you've changed banks with your tax preparer, make sure to let them know so that funds go into a active account if that's the case. But everything's calculated then on this third section. But as Missy said, we're going to break down, this middle section of the 1040 here, where truly everything shakes out.
All right. So here we're going to get in a little bit deeper dive into all the income that flows through onto your tax return. In this case, we're actually taking a look at a client's income or tax return. So in line 1A, This client happens to show W-2 wages of 153,000. So that 153,000 is actually a net number. And what I mean by that is you start off with your gross wages, and then anything that you've put away into a retirement plan, like a 401k, a 403b, a 457, that you've done on a pre-tax basis, that's going to help lower that gross W-2. In addition to that, if you're paying for benefits like your health insurance on a pre-tax basis, that also is going to help drive that number down. So in this case, what we're looking at is a net number of 153,000 of W-2 wages. Moving on, we're going to talk about line item 2B, which is taxable interest. So this is driven off of bank accounts, money market accounts, CD accounts. Anything that generates interest is going to flow through here, and this is going to become taxable on your return. So in this case, our client is showing $350 of taxable interest. Now I'm going to combine some items, line 3A of qualified dividends, 3B on ordinary dividends, and also line 7, which is capital gains. So this tells us that our client has investments outside of a 401k, so brokerage accounts where they may hold mutual funds, mutual funds, unit investment trusts, stocks, bonds. Those are generating dividends, additional interest, and in this case for our client, they sold some investments throughout the year that generated capital gains. So we'll talk about this a little bit more in depth, but the qualified dividends and the capital gains are actually going to receive special tax treatment. And finally, I'm going to talk a little bit about, line item 4A. So this client actually did a distribution from an IRA. And we know in this instance that this client actually did a Roth conversion. So they took money from an IRA and then they converted it to a Roth IRA. And now that it's in the Roth IRA, the earnings on that Roth will grow tax deferred. And then at a point in time in the future, when they need to draw from it, that money will be able to come out 100% income tax free. So when we add up all of our income sources between W-2, interest, dividends, and the Roth conversion, we get total taxable income, or total income, I'm sorry, of 180,155. And then on line item number 12, you can, we're looking at either a standard deduction or an itemized deduction. And in this case, our client is taking the standard deduction of 27,700. So that gets deducted from the adjusted gross income. And that drives down their income to a taxable amount of 152,455. Now, Henry, as I just walked through this, what are some of your observations that you're seeing with the numbers that I just covered?
Yeah, so thank you, Missy. I think first thing that, we typically see, you mentioned lines 3A, 3B, and 7. These are things that tend to show up on a client's tax return, that are passive, meaning I hold investments, I didn't sell anything. They've grown over the year, and then I get a 1099 at the end of the year showing how much in dividend, and in this case, capital gain distributions happen. So you mentioned in this example, the client sold something. Oftentimes clients don't sell anything. So it's very concerning for clients when they get large distributions from a mutual fund portfolio that shows taxable income, and now they have more tax to pay, and all they did was hold the same investment on January 1st and December 31st. So that would be one thing I think we have a tendency to look at and help clients understand, is understanding what income your portfolio will produce, and then are there some opportunities within your portfolio, if You do have capital gains where there may be some capital losses you could go harvest to make sure your tax return, stays in line, or frankly, to make sure you don't pay more tax um, than you need to. So that would be the first observation is, are you deploying strategies of gain and loss washing, or is it just passive and these things just happen year in and year out? Missy, what are your thoughts on interest on the tax return here of 350, and then what we see most clients carrying in cash and interest rates in 2024?
Yeah, I mean, that's great observation there too, Henry. With the Feds and raising interest rates, it's created a very unique environment in our short-term interest rates. We're seeing higher yields today on money market accounts, savings accounts. So people are holding on to a lot of cash today because of those short-term high yields. So in this example with our client, showing $350, I mean, if they held the same amount of cash in 23 for 2024, I mean, that $350 number could potentially triple or quadruple for 2024. And these are things that, we want to be aware of, so as we're looking at potentially doing projections for clients and understanding, the larger those numbers are, whether it's the dividends or the taxable interest, that can create different scenarios for the client. Could that mean they're paying more in income taxes, less in income taxes? These are the different things that we can, help shed light on for clients. Yeah, so I
Right. I
think
mean, as the election approaches, people are concerned. I mean, would you agree, Missy, more people are carrying higher levels of cash today than they have in the past?
absolutely, for
People are
sure.
paying down debt,
Yep.
and thusly storing more cash.
Yes.
It seems to me, this is something that is occurring on a regularity. Um, with our clients,
Yes.
carrying more
For sure.
cash, higher interest means higher tax.
Yep. Yeah, because the taxable interest is being taxed at ordinary income rates. So yeah, I mean, it's definitely a number to be aware of. All right.
So in those
So
those first few sections, it's really about having a good working knowledge of what do you own, where's it at, and are there some opportunities within what you're doing to reduce the amount of income, to control that tax bill.
right. So we're going to take our client back to our tax brackets again. So we know this client has roughly $152,000 of taxable income. So Henry, share some share some light on, what that 152,000 means as far as our tax bracket here.
So as we referenced before, we see most of the time clients understand there are tax brackets. How it's implemented is more murky than it is clear. So at 152,000 of taxable income, it's clear this client's in the 22% tax bracket. What should be noted is only the amount above 89,000 up to the 152 is taxed at 22%. So Missy did a great job explaining the benefits of an IRA to Roth conversion. That $15,000 is taxed at 22%. This is what we see on an everyday basis. There are cases where that $15,000 had to be an IRA withdrawal because we know Murphy's Law is a law, not a suggestion. The furnace went out at the same time the air conditioner went out, and maybe there were car repairs. We understand that. Um, it's how do you see and understand what's happening here, to know where do you land. Yeah, I think it's important to note, rough math, 15,000 at 22%, is about 3 grand of tax, right? And this client
Mhm.
owed 1591, if you recall, on the tax return. As long as they are aware that that transaction is what causes them to be there, that makes sense. What we see many times is that it's a surprise. People don't know that having that transaction now means I owe at tax time. So again, in that case, the goal is to pay taxes at 22% versus at higher levels in retirement. Is that a conversation, Missy, that happens, very often with you? Is, hey, my tax rates, going to be higher in retirement, or I want to make sure I pay taxes at these rates?
Yeah, it's almost an everyday conversation, and I think that's a big fear for a lot of people is they're not sure where tax rates are going to go. They anticipate they're going to go up to what level, to what degree. That remains to be seen. But being able to take advantage of the lower tax rates that we're in today, um, clients tend to want to be able to take advantage of that in any way possible.
Yep.
All right. So what we're going to take a look at now is where we were prior to the Tax Cuts and Jobs Act that was put in place back in 2017. So in 2017, we had the TCJA put into place. And what that did is it kept our 7 progressive tax brackets in place, but it widened the amounts in each of those tax brackets so people could earn more money without moving into a higher tax bracket. So if we look for our client in this example, that 152,000 of taxable income back in 2017 would have been at the highest level in the 25% tax bracket. But looking at it in 2024, if that scenario were to play out exactly as it did in 2023, now we've got, they're still in the heart of the 22% tax bracket, thus allowing, instead of, I think Henry mentioned $40,000 of room in the 22% tax bracket, now this client's got $50,000 of room to potentially max out the 22% tax bracket. So the big unknown, and we had mentioned it earlier, is, Henry, where do you know, where do you think trajectory wise our tax rates are going to go for the future?
Yeah, I mean, when we ask folks and take polls and get feedback, most everybody believes tax rates have to go up, right? We're somewhere around $3 trillion of government debt. The only way to start paying that back is through taxes. Until we start cutting programs as a country, that's the only way. As far as what does that mean for folks, I think this is a very, interesting slide. To think at 152,000 of income, you had the chance to pay taxes at 22%. Was that by mistake, which we often see that folks knew some form of Roth conversion made sense, but they don't really know how to do the planning, to see what's the right route to maximize that tax bracket. So again, to have the potential to pay another, or to convert another 50 grand and still be in the 22% tax bracket versus in retirement, I'm going to pay 75, or excuse me, 25% on that same amount, makes a ton of sense for folks, provided you have the capacity and ability, to pay, the tax on that conversion. Most people believe, regardless of who wins the election in November, both sides of the aisle are not going to agree, to make these permanent. That's an uphill battle, which means, we're returning to the tax laws we see, in 2017, in a matter of 18 months. So we really have 2024 and 2025 to look at some opportunities, to pay lower income tax on dollars clients have saved for 20 or 30 or even 40 years at current tax brackets. This is where tax planning and looking ahead really can have a huge impact for people, in the success, of meeting their future retirement goal.
I think you said that very well. And again, where we are for the next 20 tax year 24 and 25, because, you know, the Tax Cuts and Jobs Act as it stands right now is due to revert or end at the end of 2025. So taking advantage again of our lower tax rates, and helping clients plan for that is important, and it's what we do well.
Yeah. So at the end of the day, what really helps people understand, the difference between, a comprehensive model and that of a transactional model is what we just walked through today. A comprehensive model in tax planning, as Missy referenced, is about the present looking to the future. Think of it in sense of you're in a vehicle, you're looking through the windshield. You're talking about where are you going? This is where I'm at, and I want to get to the next exit or the next place. It's thinking about the tax return in the sense of how can we control and look at it in comparison to where are we going to land and be at retirement. That's why ideas like gain and loss washing, for capital gains make so much sense to people. It's why doing Roth conversions makes so much sense to people. A transactional model is looking through the rear view mirror. It's about where you've been. Once you're at the stage of completing the tax return, there's very little you can do to impact the outcome of the tax return. It's factual, it's done, it's historical in nature. That's the difference between looking at your situation in a comprehensive manner versus a transactional manner.
All right. So for everybody on the call today, you can actually go to blumarktax.com and check out all of our latest blogs, our frequently asked questions. We've got useful calculators on the website, as well as other links to great resources to help answer some questions. And better yet, make it easier for you. If you want to take your phone and scan the QR code at the very bottom of the page, it'll take you right to the website. And that's where you can learn all about the information that would be helpful for you under the blumarktax.com website.
So again, we thank everybody for attending today. As Missy said, we've got a lot of information on the website. We've done other webinars. We'll continue to do them. We believe a big portion of what we do is educating clients on, where are things at today? Where are they heading? Giving you a better feel and understanding, um, for your situation as well as, um, opportunities that exist. If you do have any questions, you can see here the phone number to reach us. Missy mentioned the website. You can send an email to info@blumarktax.com. We'd be happy to reach out to you individually to answer any questions you might have. We thank everybody for attending and giving us the time today. We hope you pulled some useful nuggets out of it and enjoyed the time. And we look forward to hearing from all of you in the future. Have a great rest of your day and your week.
Thank you, everybody. Appreciate your time.